coming due for a 4-year cycle low in the stock market. When that happens, central banks are going to start printing like crazy again. And I think that would light a fire, not only under stocks, but I think it would light a fire under commodities as well. So, well, at $10,000 gold, if we get to 30 to 1, you're looking at $300 silver. So, I've been on record for years now that $100 silver is going to be a piece of cake. Again, doesn't mean it's going to be an easy move to get there, but it's going to get there. I think 250 is very likely, and I think 500 is possible.
Gary Savage, financial analyst and founder of the Smart Money Tracker newsletter. It's a true pleasure to host you on Palisades Gold Radio today.
Thanks for the invite, Stijn.
Excellent. Excited to hit the ground running, and I would love to get started talking about gold. We're in the midst of an incredible bull run for precious metals, and gold's up over 60% year-to-date, outstanding returns. However, Gary, your view of analyzing this bull run is a bit different than other analysts. So I would love to start there. From your perspective, where are we within the longer-term cycle for gold?
Well, I think it looks like we're getting fairly deep into the second phase of the bull market. The first phase was from, take your pick, 99 or 2001. We double bottomed it at $255. And that first phase topped in 2011. And then we had a cyclical bear market within a long-term secular bull market. We started the second phase of that long-term bull market when that bear market ended in, I think it was October. It was late fall of 2015. We started the second phase of this long-term bull market, and so we're getting pretty mature in that second phase. We're going on 10, 11 years now, and gold is starting to go somewhat parabolic. If we lose the wall of worry, and by that I mean we kind of quit having normal corrections, then I'm going to say we're in the final parabolic stage, and we've got generally when the general public starts to take interest, you got about a year to a year and a half, and then that at some point there you just run out of buyers and the bull market tops. Usually the fundamentals will have already changed months before that top. We are kind of threatening to lose the wall of worry here. We're at least in a correction in the metals, gold especially. This correction could go sideways like it did from April to August of this year. That would be one way to correct. We just go sideways and we give some of the long-term averages a little time to catch up to price. Or we could have more of a kind of an ABC type correction where you get a first leg down, a bounce, and then a second leg down. I don't know if it's going to happen, but I would really prefer the second. We're stretched quite far above the 200-day moving average. We haven't really closed much of that gap. If we could get, and I know almost everybody's bullish, and that makes me a little bit nervous that we might have a quote unquote C wave down into the beginning of the new year. That's what I would prefer to see. That would keep the wall of worry alive. And if we can do that, then the bull market lasts longer. It's not going to top in a year or a year and a half. It could still have 2, 3, 4 years left if we can keep the wall of worry alive. So even though it means, temporarily you take a few steps back, or, I certainly would not want to be in leveraged positions right now, because we're either going to go sideways or we're going to turn down and make a lower low. But to get the maximum amount of upside potential, we need to stay in that wall of worry. So I'm kind of rooting for the ABC correction that takes us down closer to that 200-day moving average. That pushes our final top out, not a year or year and a half. It probably pushes it out like maybe at least a couple, like 2 or 3 years. So instead of, I'm on record that 10,000 is going to be a piece of cake. Doesn't mean it's going to be an easy trip to get there, and it won't be. It'll get more and more volatile as we go along, but I think we're going to get there. But if we can stay in the wall of worry a little bit longer, we might even get to 15,000 or 20,000 before this bull market's over.
Incredibly interesting insights there, Gary. Of course, with the wall of worry, if we can keep it, this bull market might have some more years in it, which, could be very interesting. You mentioned almost everyone is bullish, and of course, it definitely feels like that in the precious metal sector. But if you look at generalist investors or, track inflows into ETFs, one could make the argument that the generalist investor doesn't really care about precious metals just yet.
Well, I think that like the mom and pop investors, people that don't really know what they're doing, they just see that their neighbor's making money and they want to make money. I think they just started to enter when gold went above 4,000. That caught their attention. I've told this story before. I have a friend, a rock climbing buddy. He knows absolutely nothing about investing or gold or metal or anything like that. He called me like a couple days right before that recent top. And he said, "What's going on with gold? It's over $4,000. That was a bell ringing. It's like, we're at the very least, we're due for a correction now, because this guy that knows nothing at all about investing is calling, asking me about gold. And sure enough, we're in a correction, whether it be another sideways one, or whether we'll get a leg down that makes a lower low below, I think it was 3,900. One way or another, we're in a correction. So I don't expect that we're just going to take off, and make a big sustained move above 4,400 just yet. Like I said, ideally we could get a C wave down and we could drop below that 3,900, knock off all those people that were, at the bullion shops buying metals, and sentiment is pretty bullish in the gold bug community right now. I mean, all I'm seeing on YouTube is silver shortages, silver to the moon, yada, yada, yada. I would prefer not to see that kind of sentiment. I'd like to see some really negative sentiment, which we would get if we can get an ABC correction. So we'll just have to wait and see here. The FOMC meeting is kind of a trigger event. If we move down into that, then we would get a bounce. And if that bounce kind of runs out of steam quickly and then we turn back down, then that would be the ideal situation. Just have to wait and see, because I don't know if that's going to play out or not. But at the very least, I think we're going to go sideways.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. All right, well understood. And of course, you want to be on the contrarian side of making this bet. You mentioned that we could potentially elongate this bull market if we keep that wall of worry alive. Another way that we potentially could keep it alive is, just fundamentally driven. A lot of more fundamentally driven analysts say that this bull market is driven by either debasement of the currency, central bank buying because people are losing trust in the United States dollar, or a bit of both. Could that, in your mind, also potentially be a driver for a different bull market than we have seen before?
Well, it's definitely a driver, but bull markets end when the fundamentals are most compelling. So I tend not to get caught up in these narratives that price can't go down because of such and such a reason. Usually, at a top, when everything looks most bullish, there's some rot going on underneath the market that the average investor is not seeing. And in this case, maybe the dollar is getting ready to bottom and move back up, and the fundamentals are getting ready to change, and the market's starting to anticipate that, even though in real time it looks like there's just no way that price can ever turn and go back down. I mean, classic example, the bull market top in 2000, it just, at the top, it didn't look like there was any possible way that tech stocks, which were the wave of the future, could ever go back down, but they did. Same thing will happen with the metals. It'll top when everybody least expect it and when the narrative is the strongest for the bullish case.
All right. And if I understand correctly, you believe there might be a parabolic phase right in front of that eventual top, and we might be entering that. If you look at some historical parallels, how do you think this parabolic phase could look like for gold heading into the future?
Generally, what happens is you see your neighbors buying gold and silver and bragging about how much money they're making. Price will be stretched. It already is stretched quite far above the 200-week moving average and the 200-day moving average, but it'll be stretched obscenely far above the mean. The narrative will be bullish. Nobody will be negative or bearish, and anybody that is will be ridiculed as an idiot. The gold-silver ratio, there's two ratios I'll be looking at to tell me it's time to get out of metals. When the gold-silver ratio gets back down to between 20 to 30 ounces of silver to gold, that's probably an indication that you're pretty close to top. You need to be selling. And also maybe the Dow gold ratio would be down. I don't know if it's going to get down to 1-to-1 or 2-to-1, because I think the Dow is probably a little too high, but I think it could get down to 3-to-1 or maybe 3.5-to-1. If you see that, that's probably also a good indication that we're pretty close to the top, and you need to think about controlling greed and not getting caught when the bubble tops, because these parabolic moves, they go straight up and they also go straight down.
They go straight up and they go straight down. Very, very interesting. And Gary, what is your preferred way to, play this bull market in gold specifically? Is it just physical bullion?
So in the S&T, we're doing two things. Our portfolio is split. We have 80% in physical gold and silver. That's our insurance. We don't trade that. I don't try and dodge corrections in the gold and silver. We've been holding for several years now, and we've made some, amazing gains, even though we've had to weather some significant pullbacks. The other 20%, because we have broken out of the cup and handle. We did break the suppression in the gold market when they couldn't drive it back below 2,000. That's resulted in this huge short squeeze rally that has taken gold from 2,000 to 4,400. So we're playing these intermediate cycles, the advancing phase of these intermediate cycles, with some leverage. And then at some point when the rally gets mature and it becomes a little bit dangerous, you don't want to get caught in an intermediate decline in leverage. So we'll just, control greed, be happy, take profits. Last year was a very good year. I think everybody probably made between 100 and 200%. This year's been massively better. I think everybody is probably up at least 150 to some people are up 500% if they've got a little bit more aggressive. I think next year will also be as good or better, but I think the market's probably going to get more volatile, which means a little bit harder to hold on to positions. But that's what we're doing right now with the 20%. We're playing the intermediate cycles with leverage, but our insurance is our physical position in just physical gold and physical silver that we just hold, and we'll sell it when we see those ratios get down to levels that indicate the top. And our neighbor's bragging about how much money he's making gold and silver. I'm going to sell my gold and silver to him.
All right, well understood. So you're really looking at this bull market in gold and silver as a trade to benefit on, rather than for example, structural shift that we might see, like some analysts are predicting a revaluation or remonetization.
Like I said, there's always a narrative. I've heard them at every intermediate top, all the reasons for why price can't go back down. At bull market tops, long-term secular bull market tops, there's always a narrative for why price can't go down. classic example in oil in 2008. The narrative was that we were running out of oil, even though there were tankers sitting in the Gulf with no place to unload their oil. And we saw what happened. That parabolic move collapsed, and a lot of people lost a lot of money. So don't get attached to these narratives. It's never different, and it's never the end of the world. Humanity always eventually will make the wrong decision 100 times in a row, kicking the can down the road until we have to make the right decision. But ultimately, we do what needs to be done. So it's not going to be the end of the world. It's not going to be the end of the monetary system. I don't think gold is going to reach a permanent high plateau and then stay there any more than the housing bubble was going to reach a permanent high plateau and stay there, which I heard that back in 2006 and 2007, and we can see how well that worked out for people. So don't get attached to these narratives. When it becomes apparent that we're in a bubble, that means gold is severely overvalued, and you need to start looking for something that's undervalued, and it'll be the complete opposite. The narrative will be that there's no way this can ever turn and go back up. I heard that back in 22. The fall of 22, that was an 8-year cycle low for gold, and the miners were just getting crushed, and people were negative on miners. I'm never going to buy these things again. And I was trying to tell people there's, even though these are kind of crappy businesses, there comes a point where even a crappy business is too undervalued, and you have to buy. And I was trying to get people to buy, and it was the exact opposite of what it is today. Everybody thought I was an idiot for wanting to buy miners or metals at that bottom in October of 2022, but that was the time to buy. They were undervalued, too undervalued even for a crappy business. And at some point, they're going to get too overvalued even for a good business. So, if you take nothing else away from this interview, don't buy into narratives. When something gets extremely overvalued, you gotta sell. So there will be a time to sell your gold and silver.
Incredible advice there. Don't buy into the narratives. Really appreciate that, Gary. I would love to talk about silver for a second, because it seems that you're quite enthusiastic about the immediate future for that metal.
Yes, maybe. I'll qualify maybe. If gold were to give us a C wave down and drop below that 3,900, then silver is going to have a correction too. I don't think it will just decouple from gold and keep going up, while gold is going down or sideways. 60 is a psychological resistance zone. It looks like price has turned back down from that 60 level. Now we do have a breakout above 50, so it's potential. Even if gold were to drop back below 3,900 and give us a C wave, silver might hold that $50 breakout, and then it would be set up for a big move to. Well, I think we're going to get to $100 in 2026. We might get to $100 as early as late spring or early summer, but I think at least by the end of the year, I think we'll get to $100. So I think there's a lot of potential in silver, but I'm a little cautious. I don't think I want to be leveraged in any of the metal sector at the moment until I make a determination as to whether or not I think gold is just going to go sideways, or whether it's might give us kind of a sneaky C wave decline that nobody is really anticipating right now.
Well understood. And that $100 target by 2026 is, of course, truly exciting. However, you earlier outlined that you believe a gold to silver ratio of about 20 to 30 to be a signal of potential top. If we were to move there from currently, it's a bit above 70 right now. That could be, even a bit higher than $100.
Oh yeah, if at $10,000 gold, if we get to 30 to 1, you're looking at $300 silver. So I've been on record for years now that $100 silver is going to be a piece of cake. Again, doesn't mean it's going to be an easy move to get there, but it's going to get there. I think 250 is very likely, and I think 500 is possible, especially if we can keep this wall of worry alive for another year or two, then I think $500 silver is probably, I won't say piece of cake, but I'll say pretty likely.
Wow, $500 likely. That's incredibly interesting. So I guess really what is important to understand of your take here is that while you are long-term still incredibly bullish on the precious metals, short-term and medium-term, one should expect significant volatility.
Yeah, well, I mean, we are in an intermediate correction. It just, I just can't tell at the moment whether it's going to be another one of these sideways things like we experienced from April to August of this year, or whether it might be a more normal ABC move. And if that's the case, then we'll have a scary undercut of that 3,900 low. It would probably come in January, would be my guess, if that's what's going to happen. But we'll need a little time for that to develop. It's not going to go straight down. There'll be bounces along the way. So we are in an intermediate correction, so I don't think you have to worry about the metals running away from us immediately. And if it does, then we are in that last year and a half, and we're in the final parabolic bubble phase. But I'm hoping that we're not. I'm hoping we can keep this wall of worry alive for a couple more years at least.
Yeah, all right, well understood. We hear a lot about potential suppression in the silver market. Do you think there's any credence to that?
Well, there was a lot of credence for many decades, but I think it broke. The suppression of the gold market broke it when they couldn't drive it below 2,000. And like I said, you see the short squeeze that happened, took it to 4,400 in a year and a half. The suppression broke in the miners. They've broken out to pretty big all new highs. And I think the suppression of the silver market broke at $33. If you look at the chart, they just, for weeks and weeks and weeks, they kept hammering it, trying to keep it from below $33. When it finally broke out above that, we made a run. I want to say we made a run to maybe $37, another resistance zone there, and we went sideways for a bit. But then that broke out again, and we made a pretty quick run to 50 and then to 54. So I'm pretty well convinced there may be some short-term manipulation and suppression from time to time, but the serious, significant suppression is over in the gold market. They've lost too many billions of dollars. They can't afford to do that anymore.
And talking about the gold and silver miners for a second, of course, earlier you outlined that in 2022 you were bullish on them. How are they looking right now? From a fundamental perspective, we hear often that they're trading at attractive price to cash flow multiples, even though they have gone up significantly already. Is it something where you think you can still find value, find alpha?
Well, you can certainly trade miners. I'm more partial to silver because I think it has a lot of catching up to do. Gold and miners broke their suppression early last year, and they've made some huge gains. So I tend to think silver will outperform. But you can certainly, there's no reason you can't trade all three. You can trade gold, silver, and miners. But I would wait. The miners, I don't think, are going to decouple from gold. So if gold is in an intermediate correction, the miners are too. Again, whether or not it's going to be a sideways churn or a deeper correction remains to be seen. But once that correction is over, you can certainly trade miners. They'll do fine. I just think you might get a little bit more outperformance in silver, but certainly trade both of them.
What do you think of miners as a leverage play to gold? Of course, they have an entirely different risk profile than options or margin have, and they can still provide leveraged upside to gold.
Well, they will deliver bigger percentage gains than gold, but just, unless you just happen to catch a junior miner that's going to go ballistic, you're not going to outperform leveraged trades in, say, silver or SLV with unleveraged miners. So, we're, like I said, we're playing leverage out of these intermediate bottoms, so we tend to, we're not really focusing on individual. I never buy individual stocks anyway. I buy ETFs. But if you want to get outperformance, you just use some leverage on. You could literally just use leverage on GLD and outperform miners. So, if you want outperformance, that's the way to do it. You just trade these the advancing phase of these intermediate cycles with leverage.
Well understood. And Gary, what about other precious metals? For example, I recently had Francis from the Market Sniper on who talked about platinum, incredibly small market and interesting supply demand dynamics. Is that something that's on your radar?
I don't diversify into a small market like that. I'm not very familiar with that market. If you want to trade a white metal, I don't think anything's going to outperform silver. So, if you're looking for a white metal to trade, I don't know why you would go to platinum instead of silver. I think in the long run, silver will massively outperform platinum. So, I'm perfectly happy just to stick with silver.
Perhaps we can quickly talk about equities for a second, the SP 500. If you look at the longer term cycle there, where do you think we stand, Gary?
We're still in a bull market. I don't think the bull market is ending soon. The last two secular long-term bull markets both lasted over 20 years, and they both tacked on like 20 times from the bottom. This bull market, well, I guess it started in 2009, so what are we, like 16, 17 years in? And last time I looked, I think the S&P was up maybe 9, 10 times, something like that. So, and the new technological advance, robotics, AI, I wouldn't say they're in their infancy, but they're maybe early adolescence. So I think we got further to go. Now, I will say we are 3 years into this 4-year cycle, and you got to have some time for the declining phase of the 4-year cycle. So I don't know that we have a huge amount of upside potential before we start that declining phase. So I'm not really interested in stocks right now. If we get a Dow Gold ratio of 3 or 3.5, I'd be very interested in stocks. I'd be interested in selling my gold and buying stocks, and maybe that happens, over the next year or two. But right now, just too late in the 4-year cycle. Market's too stretched above the long-term mean, and I just don't think there's a huge amount of upside potential. Certainly nothing compared to what you're going to get trading the metals. So I would be more inclined to just be a little patient and wait for this correction in the metals to be over, and then go heavy again in the metals when I think this intermediate degree correction has run its course and we're ready for another leg up.
All right, well understood. And of course, like you outlined earlier, equities are a bit stretched. Valuations are also on a multiple basis quite historically stretched. Do you think there's a potential for a recession risk or a bear market in equities, and through that a capital rotation into hard assets or traditionally seen safer assets?
Generally, a recession is caused by a spike in inflation, and by that I mean a spike in oil. 100% or more in a year or less is usually such a shock to the economy that, and everything has an energy component. So when energy spikes, the price of everything goes up. And the middle class and lower class shut down their discretionary spending. Unless we just sabotage ourselves and close the world down for a virus. Right now, oil is in a bear market, so I don't see that causing a recession. Now, if the war cycle were to all of a sudden accelerate again, that might cause a recession. So as of right now, I'm assuming the 4-year cycle low is probably just going to be a normal profit-taking event driven by price getting too far above the mean. But if the war cycle was to accelerate, then we might have a recession and a big correction in stocks driven by middle class and the lower class and the upper class as well, getting fearful and starting to save and not spend.
War cycle is an incredibly interesting framing. Do you believe that geopolitical conflicts happen in a recurring cycle, almost like a fourth turning style concept?
Well, about 2 weeks into the lockdown, I predicted that we were going to ignite the inflation cycle and the war cycle, and sure enough, we did. And human beings especially politicians, they don't tend to admit a mistake. They double down on failed policies, or, we just didn't spend enough money on, and that's why it didn't work. So really the only thing that's going to stop the inflation cycle, we've kind of got it under control, but it's not going backwards. The only way to make prices cheaper is by having a hard recession. Of course, no politician wants that. And then generally the war cycle follows on the heels of the inflationary cycle, because economies start to suffer. And then when politicians can't fix the problem, because the fix is to push the economy into recession, they're not going to do that. Usually they'll just keep printing anytime things look a little iffy. That just exacerbates the inflation cycle. And so when economies start to decline and people start to complain, and if the politicians can't fix the problem, then they look to blame somebody for the problem, and they start a war. And so, we've got 2 ongoing, well, maybe potentially 3 ongoing wars, and I suspect it's going to get worse. And like I said, humans will just do the wrong thing 100 times in a row before we're forced by reality to make the right decision. So I suspect the war cycle, I hope I'm wrong, but I suspect the war cycle is going to continue and probably get worse.
Well understood, and an incredibly interesting concept. You were talking about oil and gas a bit earlier, and specifically oil, that it is in a bear market currently. Some fundamentalists, like for example a Rick Rule, are slowly but surely turning bullish on the commodity, saying cheap is cheap enough. When would cheap be cheap enough for you, Gary?
Well, I need to just see a turn. Rick just sees value and he's buying, and he has probably a 10-year time horizon. I would like to try and time a turn maybe a little better. And it may come soon, but I'm not convinced that oil has turned the corner yet. So, maybe when I'm ready to sell my gold and silver, maybe it'll be time to buy oil or energy stocks. But at the moment, still looks like a bear market to me. Prices underneath a declining 200-week moving average. So not ready to jump in just yet, but I will be at some point.
What would be an indicator for you to take a position in oil?
Yeah, you could try and pick a bottom, but in this kind of a bear market, the bottom very often will be a long period of choppiness, and then eventually it'll break out and start a trending move higher. So I guess maybe if I were to see, 6 months, a year and a half of choppy market, that's not making a lower low, but isn't really getting any upward momentum yet, and then I see like a big breakout move, that might be the bell ringing for me that it's time to start pushing the trades in energy.
All right, well understood. Perhaps another topic we can quickly touch base on is global liquidity. There seems to be a lot of fundamental reasons to believe that we might see a spike in global liquidity soon. You have Federal Reserve, for example, cutting rates, now switching towards quantitative easing. Governments are refinancing their debt. This liquidity would need to find an outlet. A lot of people are predicting this might be hard assets, commodities. This could be a drive for a type of commodity supercycle type of idea. Is this something that you take any credence to?
I would tend to agree with that. I think commodities, the bear market in commodities bottomed in 2020 when oil went negative. If that's not a bell ringing the end of the bear market, I don't know what is. So commodities are in a long-term secular bull market. Now, if the stock market, like I said, we're coming due for a 4-year cycle low in the stock market. When that happens, central banks are going to start printing like crazy again. And I think that would light a fire, not only under stocks, but I think it would light a fire under commodities as well. So I'm in agreement on that one, but I tend to want to wait until we get that 4-year cycle low in the stock market, or we get an end to this intermediate correction in metals before I want to play that.
And I guess this commodity super cycle you would view as a sort of peloton race. Some are pulling ahead, some are lagging, rather than a rising tide lifts all boats.
Yeah, the second phase of a bull market is usually led by something different. So oil kind of led when it went up to whatever 140, and now it's in a bear market. Now gold is leading. It's leading the second phase of this commodity bull market. So at some point, I think it'll turn around and oil will lead. But that is correct. They rotate, and I think oil is going to be the one, or the sector to be in during the last part of this commodity bull market.
Gary Savage, incredibly interesting. I would love for you to talk a bit about the Smart Money Tracker newsletter to us.
All right, so I have reopened the S&T for yearly subscriptions. I only do yearly subscriptions. I am solely focused on the metals, simply because we've broken out of that cup and handle pattern. We've broken the suppression across the board in the metal sector. As I said, we're trying to play the advancing phase of these intermediate cycles in leverage. Our long-term positions are in physical gold and silver. I don't get distracted into other markets when metals are correcting like they are right now. I'm not, desperately searching for something to trade right now. We're just kind of sitting on the sidelines waiting. If that's what your focus is, to focus solely on metals, you're not interested in trying to jump all over the place trying to make something happen, you're willing to be patient, wait for the right setups, and trade metals and trade leverage with that 20%, then by all means, join the S&T. We had a great 24. We've had a massive record-breaking year this year. I think next year will be even better, although, like I said, I think it's going to get more volatile, harder to hold on to positions. But, I think we've got a lot of potential in the metals over the next at least a year and a half. If we do lose the wall of worry, and if we can keep the wall of worry alive, we've got probably 3 or 4 years left in this bull market, maybe even a little more. Oh, and the quickest way to find me is just on X. It's Gary Savage 1.
We'll definitely include that in the description. Thank you so much, Gary, for your time and your insights today. Really appreciate it.
Thank you, Stijn.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.